have the recordings of Tuesday night and tonight to you, hopefully sometime tomorrow afternoon. And again, you'll get that via email from the financial literacy department, and take a look at that in your spam or promotions or any other weird folder that you might have that some BCS emails go to. On that happy note, let's pray. Lord, thank you for this time. Thanks for another warm, comfy day and dry. And it's great to have a dry, warm day. Thank you for these wonderful families. And I pray tonight as we get real specific and technical around these topics of insurance and financial institutions and credit, that families would wade through some of these details and be encouraged, confirmed, and emboldened to make choices according to their family vision. Thanks for this time in Jesus' name. Amen. So question, if you would, again, tonight, chat, feel free to use it as much as you would like. As I'm working through the content, if you're like, I can't wait till the end to ask this, feel free to put it in the chat and we'll take breaks throughout the time to be able to address those. Again, if you got real technical questions, go for it. I would love to hear briefly, and go ahead and use the chat for this. How has the last 46-ish hours since we were last together been in relationship to the conversations that hopefully have been going or have started since then? So if you would briefly just say, hey, it's going well, or wait, we were supposed to communicate, and anywhere in between, we'd just love to see a little bit on how things are going 2 days in. Excellent. Thanks, Tess, for that. Had a little bit of time to start chatting with family. Good. Ooh, cool. Spent some time talking about time and stewardship. Thanks, Scott. Going well, encouraged. Excellent. And about stewardship. Good. So processing, a little overwhelmed. Yeah, that's fair. And I'm just going to add to that tonight. But it's okay. We're going to dump a bunch, and then moving forward, you slowly digest it, if you will, over time. Working on spending more time on it this weekend. Excellent. And just a little side note on kind of the content and feeling a little bit overwhelmed or wanting to work on it a little bit over the weekend, is that any kind of emotional stirrings that this class brings, whether you get super annoyed with some of the stuff I say or really excited or somewhere in between, that's not going to last long. And so particularly if you find that you're encouraged or excited, like, yeah, we really want to run with this, you might have 7 to 14 days of that, and then the emotion's gone. And why I'm saying that is that it's a brief window of delighted stirrings, if you will, to capitalize on. So my encouragement would be to use these nights as a piggyback into the future to continue the momentum and put stuff into practice as quickly as you can. So that way you carry on some of that. Family vision, excellent. Just need isolating goals from values. Yeah. Got some good insight, lots of conversation over with husband. Great. Love hearing that. Spark conversation. Excellent. Working on the family vision. Great. That'll take some time. I didn't share this on a Tuesday night, but my wife and I, we have been on this concept, working at it for deliberately probably about 7 years now, 8 years. We just didn't show up and be like, boom, here it is. It's been this evolving, changing, shifting thing that we've been working on for years now. And it's actually been a really good process as we change things and tweak things. But I just love the framework that it gives us to make good decisions. So I encourage you don't have to get it all done in a weekend. Had a little bit of time, but working on it. Good. So working on it, working with the kids. Yep. Glad I got you thinking about values. Love that. Somebody said, stopped on a spontaneous purchase. Excellent. Work schedules, not too much talking tonight yet. Talking about the 3 categories, good. Started a little bit. Excellent. Thanks for saying that, Joy. Got conversation started, but then it's a little bit like, oh, this is getting a little harder. Processing, good. Good. Thinking of framing things in stewardship language, good. Productive, excellent. Pause to go shopping, talking about visions, working on mission statement, excellent. Okay. I appreciate you filling that in. Keep those conversations going. Yeah, I'm encouraged. Excellent. Glad to hear that. All right, I have a poll for you. And some of you have already answered this in the chat, which I'm excited. So real quick, the question is, have you started talking about your family vision yet? Again, I saw a lot of that in the chat. So if you have, go ahead and do it real quick. If you haven't, put that in, or if you're planning to, if you feel a little bit stuck. This kind of gives me a little bit of pulse collectively as to where we're at as a class. Waiting for a couple more people. Good. All right, I'm going to shut it down. Okay, so we have majority of folks are saying, yeah, we started it. Love that. A couple people are not yet. The rest planning to this weekend, and one don't know where to start. Good place to start. This could be, this might work well, it might not work, kind of depends on you, but maybe something along the lines of, where do you want to be in life? Maybe pick an area to be specific. Where do you want to be, let's say, in your health in 10 years? Start with that. So maybe pick a time frame in a category that you are interested in specifically, and then begin to just work backwards from there. And test that process for a little bit, and then see how that goes. That's one recommendation. I'm sure if I open this up to everyone, you would probably all have some good stuff to encourage. All right, so as Becca said, page 20 in the workbook. But before we dive into financial institutions and credit, I just want to remind us that even though I'm not going to be working through stewardship and family vision, relationship to money stuff again, we don't move on from that. We build on it. So when we put on, remind ourselves that we're going to put on the lens of what does it mean to be a good steward in time, talents, and treasure, namely cultivating and protecting. And we understand a little bit of our relationship to money, and we have a vision for ourselves. I'm presuming that, of course. Now, in light of those 3 pieces, how do we then approach, dialogue, interact with, research these next topics tonight? So make sure that you keep that lens on, what does it look like to be a good steward? What's my understanding of my relationship to money, and where are we headed as a family? Then I think financial institutions, credit, insurance is going to make a lot more sense to you in your unique situation. All right, so briefly, I'm not going to deep dive into this, but I just want to highlight a couple of things. And what I'm referencing here are the primary institutions that you entrust the majority of your money to. So things like banks, credit unions, online banks, phone apps, insurance companies, investment firms. It's not on this list, but it's part of it. Credit card companies, like any institution that you engage with your money, this is what I'm referring to. And those things, in my view, are tools to serve you, not the other way around. So it's okay when you rock on up to an institution to ask some fascinating questions. Some of those questions are in the workbook there on page 20. But the idea is, how do we be good stewards in light of financial institutions? So if you look at your bank or credit union and you don't like the fees, or you're kind of fed up with the interest rates, you don't have to stay there. There are enough options right now that, first, every account you have should be free, with the exception of probably credit cards. The primary institutions that you use your money with and for, you should not be paying fees to keep your money there. Now, if you overdraft, well, then sure, you're going to pay the fee. Do you know and understand all the products and services your financial institution provides, particularly the ones that you engage with? Do you know inside and out? Now, granted, probably like most of you, I don't read the update and agreement forms, all the fine tune, like if you sign up to that. I don't read all that. It's a little bit dry, like the iTunes update and agreement stuff that I don't know if anyone's ever read those. I haven't, but we're still responsible for them. So whatever you engage with, just know what you're getting into. I just mentioned this, is the bank charging you to have an account? If they do, it's time to switch, move on. So here's just a few questions to help audit your primary institutions to see, are they really serving us? Are they helping us manage the money? Are they helping us be good stewards? And even better, are they helping us pursue and live out our family vision? I'm going to be, as we talk through tonight specifically, I will talk through specific institutions that I personally have. Though Birch does not endorse any particular financial institution, I'm just going to share the ones that I engage with. I don't get paid to say that. Birch doesn't get a kickback to say this. I'm just landing the content and practicalities and giving you a little insight into my living room. All right, let's talk about this. You ever notice this before? So let the flames just kind of simmer in front of you here. It's a play on the words, but it's fascinating that at the heart of credit, it means you're in the red. And then in financial terms, what that means is if you're in the red, there's just negative, there's not enough. Being in the black is positive. So at the heart is being in debt to credit. But again, stepping back to our stewardship lens, it is imperative that we become better at managing our credit and knowing why we're using it and as a tool to our benefit. Now, we're going to talk on Tuesday night about systematic debt reduction. And so some of this, and we're going to answer some questions tonight. We'll answer other questions on Tuesday night, particularly as it relates to how do we get out of the debt. So credit is not wrong. And I'm sure there's probably some strong opinions here as it relates to this. But I don't want to make moral judgments on credit or debt or not debt. But just know that the system that we have to work with is designed a particular way, and we need to try and work within that. So specifically, credit is just access to money to be paid back later, whether within 24 hours or, in the case of a mortgage, a long time. So it's debt, having something and paying for it later. Of course, short-term, things like credit cards. Long-term, mention that, mortgage, car loans. Or another way to say that is revolving credit or installment credit. So the revolving is the credit card stuff or lines of credit, and then the long-term or the fixed or the installment loans, or mortgages, car loans, student loans, that kind of thing. Another thing to consider about credit is it's a game. It's not like Hillsborough, the game making company, got together with Credit World and, hey, let's play a board game, but it functions practically often like that. And so in order to play the game, you got to know the rules. And decide, as you're working with the credit world, does this really match up with what we want to be about? It's also a risk. Making a purchase on credit makes a presumption upon the future that you'll be able to pay back the amount that you agreed on, and of course, in the payments. So we need to be really, really careful about how we presume upon the future. We ought to be wise and discerning. Again, it's not wrong to go into debt, but is it wise? All right, so I just talked about maybe going into house for debt. So should we use credit to finance something? Well, it depends. What's your perspective, first of all? And culturally, some of these things are easier to swallow. Others, they're going to cause some more challenge. So these are just a few examples of financing things. On the phone bit, although I picked on iPhones on Tuesday night, often now you typically don't buy the phone outright. You just buy it as is, and then you do the 24 months or however long interest free that's embedded into your cell phone bill. So as you can see, as you work through this list, the things that make the most sense are closer to the top, and things that make the least sense are closer on the bottom. Again, these are just some things to consider. Of course, does paying more for these items fit in the family vision, or would it be better to start a category savings for said item in our budget, which we'll talk more about on Tuesday night? All right, you're gonna get sick of me saying this, but does this fit into the family vision? I hope that you dream family vision. Becca does this. Occasionally she'll come to like our staff meetings and be like, I was dreaming last night about this. I don't mean to throw her under the bus, but she has some really cool insight. The point is that the family vision is the filter, the driving force, the mechanism to use in determining decisions that we're going to make. Can we wait? Is it that pressing that we need it now? Have we learned the art of contentment yet? Have we figured out delayed gratification yet? Now, in some cases, there's not an option. If the engine blows up and you need a car, all right, we scramble and try and work it out. We really need to go to Disneyland right now. It's an inside joke. Know that the advertised interest rate for anything that you're going to borrow for is only for the highest possible credit score. So if you see an interest rate for a home loan right now at like 5.85 or whatever it is, somewhere around there, but you're at a 635 credit score, you are not going to get that 5.8. You're going to get more like a 6.2, 6.4. If you're taking out a car loan, get a loan from your own financial institution first. Although more and more car dealers are partnering with particularly credit unions to make it less expensive. Typically, when it comes to borrowing, it's just a side note, this is not your notes, it's a freebie. You typically only want to borrow for assets that appreciate. From a math perspective, you typically do not want to borrow for things that depreciate in value, because you have an inverted wedge of value. So let's say you purchase a used car, used car, and you borrow. So your cost over time is going to go up because you're paying the original amount plus interest. But in the meantime, the value of the car, because you're using it, is going down. So you create this weird inverted wedge of lost financial asset. Now, in today's current market, which is weird, in the used car space, used cars are actually temporarily, I would say, going up in value, at least momentarily. But generally, you only want to borrow against things that grow in value, if you can help it. All right, FICO score. Everyone has one. 0 technically counts as having a score. So if those of you are familiar with Dave Ramsey, he has a 0 credit score because he pays cash for everything. But for the rest of us, we probably have some kind of number or somewhere on that spectrum. Started by 2 bankers, last name Fair, last name Isaac, respectively, in the 70s. And they're trying to streamline the lending process within the banking industry at that time. Because at that point, every financial institution had some variance of a process that they would use to judge creditworthiness and risk and liability and such. So these 2 people said, hey, this would be a good idea. And I would ask, good idea for whom? Now, in some cases, yes, to standardize the borrowing was good because then you would take out discrimination or a lot of discrimination, not all of it, clearly. And it would help equalize or level the playing field for borrowers. The score itself pulls from the three credit bureaus, Experian, Equifax, and TransUnion, to help compilate data to get that number. So why do we need this? Well, pretty simple, to be able to finance something. Even renting an apartment or house, getting utilities or phone in some cases, and getting a job. Especially if you have anything to do with money, more than likely your credit score is going to be pulled. So in practical terms here, the higher your credit score, the lower your respective interest rates will be for borrowing, which the lower the rate, the smaller the payment. The smaller the payment, the more margin in your budget. Now, the lower your score is, the higher your interest rate. The bigger the payment, the less margin. So in budget terms, in Birch World, we love margin. We love space in the budget. This is why it's important, if you're going to engage with the credit world, to have a solid credit score so that your payments are lower, so you have more options to move the money around. How many of you hopefully have seen this little score marker, this little dial? This is based off of FICO score range. The other 3 companies have their own respective ranges. They're all pretty close to one another. And if you were to check all 3 credit bureaus plus FICO and now the Vantage score, which is a comparable thing to FICO, you're going to get 5 different numbers. Those numbers will not be the same. In some cases, they'll vary by 20 to 30 points or more. But it gets you close. So ideally, that 740 is kind of the sweet spot where you typically get the best rates, have the best terms. You get a bigger smile from your potential lender. But the lower the score, things get harder. And it's interesting, one way to look at this, no, this isn't right, but this is what happens in the world of credit, is that your credit score becomes a proxy to judge your character. Because they presume, based on your score, whether or not you are going to be true to your word and pay what you said you were going to pay. So whether you like that or not, that's how the credit world views us, as essentially character meter relative to our ability to pay back. This fun little ditty has been around for a long time. And this is how our scores are created. If you've not seen this before, great. Here's your chance. If you have seen this before, this should be familiar to you. And this has to do with weighted impact. So your credit score is made up of these 5 elements, and they are percentage-wise based on how much it works in your favor or against you, depending on how well you do in any of those categories. So briefly, if you notice, 2 of them make up the vast amount of space as relates to building your credit. So the amount of money that's owed and your relative payment history. So both of those are good, meaning you have a long, steady, solid payment history and low amounts of debt, then you're going to have 65% tipping positively in your favor. And that's what helps really push your credit score up. Now, conversely, if you've got high amounts of debt, not like personal loans, under the table kind of stuff, because that doesn't register on this in this world, but car loans, houses, medical debt, some medical debt, not all of it, credit cards, installment loans, lines of credit, those kinds of things, that will tip against you. The other 3 are important but carry less weight. So the credit mix has to do with how many revolving debt do you have versus installment loan debt. Credit history, that's just got to do with the length of time that you have collectively and individually towards each line of credit. And then new credit has to do with how recently did you open up something to get access, or how recently did you get a loan. So these 5 pieces influence your credit score, which then influences your interest rates, which then influences your payments, which then influences if you have more or less gas money these days to work with. So if you want to see the biggest movement in your credit, focus on the amount of debt that's owed in your payment history. Another way to look at that is just kind of in word form. I'm not going to walk through this now. You can look at it a little bit later. It just basically says the same thing, just kind of written out a little bit. All right, page 25. Just going to walk through just a brief example. This is how your credit, this is relating to credit cards specifically, how credit cards work. Besides, like, we swipe stuff, we swipe it and we get stuff. So behind the scenes, we're going to pull the curtain back a little bit. So the middle section there has to do with timing. So your statement period is from day 1 to day 30, usually. And you can buy whatever you want during that time, up to, of course, the limit that you have in your credit card. Now, just because I said that, please don't go and do it. Now, if you have lots of credit card debt and you're trying to figure it out, we'll get to that Tuesday night. But tonight, I'm just walking through how it works. So you got 30 days to do whatever you want with credit card. Then the statement period closes. Typically 3 to 5 days after that, whatever amount is on your credit cards gets sent to those 3 credit bureaus. And then they start working their algorithms, and then that's what then impacts or affects your score. So my statement date closed on my credit card. I have 2 credit cards. One we only use at Costco. The other one is for everything else. And we had a statement close date on June 17th. And I went from a 3% ratio last month to a 4% ratio. What that means is that is the credit to use ratio. So in an example, let's say you have $1,000 credit limit, 3% usage of that would be $30. 30% would be $300, right? So on and so forth. So I had 3%. This month it closed, it went up 4%. So I had a 1% increase utilization ratio from last month to this month. My credit dropped 9 points because of that. 1 percentage point. And notice I'm way below the threshold. Now that's just at the 30-day mark. So there's no interest being accrued yet, but that's what happens. So the higher you have on the credit cards at that statement close date, the bigger impact that's going to mess with your credit. After the statement date period closes, that's typically when you get your bill, and you've got 25 days to pay your bill or make the minimum payment. After 25 days, so at day 55, that's when interest starts to accrue on that amount of money that was on that statement period. Now, in credit card land, interest is accrued daily and compounded daily. So if your APR, annual percentage rate, is, let's say, just keep the math simple, 24%, then every month it's 2% being added. And I don't know, I'm not good enough to do the math in real time what that is every day. So someone out there can pull that off. So at 2% a month, it's adding, or every day broken down, it's adding every day and then compounding every day. That's why when you look at, if you ever carry a balance on the credit card statement, how fast the credit card balance can grow because of that dynamic, even though we only see it once a month. So bankers use this threshold at 30%. So if you keep your debt on credit cards below 30%, they consider that good or a wise use of credit. Ideally, you want 10%. Even better, over time, you want as close to zero as you possibly can. Which doesn't mean you don't put anything on the credit card. It just means that when it's reported, you have very little money being reported on the credit cards. So that's a little bit about how the credit card world works. I'm going to stop here. See, if anyone has any questions about credit card timing, credit to use ratio, impact, that kind of stuff, before we move on into more credit matters. To ask you a question, you said, so you pay down to 3 to 4 before the statement period. I try and get, like personally, I try and get the credit cards to closest to $0 as I can when the statement date closes. I don't always do that because maybe there's a timing factor. So for example, a week and a half ago, my team knows this, but my radiator blew on my car. 3 days before that, I replaced 2 tires. So that was problematic in several ways, but I put it on the credit card because I haven't gotten paid yet. Now I could do some other like moving, shifting from different savings. I didn't want to do that at that time. And so I had more money on the credit card than I typically do. That's why it went up that amount, but I try and keep it lowish to that 2-3% range personally. But I pay off the card usually 2 to 3 times a month in my case. Again, if you're not there yet with your credit cards, don't be discouraged. We'll get there on Tuesday in terms of strategy to get credit cards down to 0. I heard it can be bad to pay off a credit card all at once. Can you explain what that might mean? I don't have a good answer as to why that would be bad. Other than maybe the banker doesn't like it because they have to tell you to like carry a balance, and that's how you build your credits, to carry a balance. I would use an expletive, but this is being recorded. That's not appropriate. So ideally is that you pay the credit cards off often, you keep them low when you do need to use them, and then we use them as a tool to help build your credit. And if you get like cash back or points, then you siphon that stuff off to do other cool stuff. But there's no downside to paying credit cards off. There is downside if you pay them off and close them. So if you close them right away, this is part of the game factor in the credit world, right? So you should be rewarded by having zero on their credit cards and then cutting them up and not using them, right? Hey, good job, you're doing well. Well, it works the opposite. You'll see your credit drop if you cut up, if you close an account, anywhere from 15 to 25 points, depending on where you started. No, you don't need to carry a balance to show that you can manage debt. If you work in banking, do not be offended by what I'm about to say. That's foolishness. That's coming from people that really don't know what they're talking about. There's no benefit to carrying a balance, none. Because think the practical ramification, if you have a zero balance, you have a 0% utilization rate. There is no way your credit's going to drop as long as you keep it active. So there's a difference, because you can have, let's say you have $1,000 limit and you just like max that thing out, but then pay it right off before the statement close date ends, and then now it's back at zero. It shows use, but it's only reporting 0, 0, 0, 0, 0, 0, but you're still using it. So the credit card company is not going to close it, but it's just showing you 0. Yep. Thanks for that, Garrett. So that, remember the FICO score, that 30% debt amount and then 35% payment history. The payment history has only to do with, did you pay it or did you not pay it? Were you late? It's got nothing to do with the amount. So if you look at your credits, if you look at the actual report, the credit report, all you have is these like boxes that say okay, and it's like green or red. Green means good, you've made the payment. Red means you missed the payment. And then if there's red and a number like 30, 60, 90, that means you were 30 days late, 60 days late, 90 days late. That's the negative piece. But the only thing that is on there is the balance at the time that the credit card was reported. It doesn't say how much your payments were. It just says, did you make the payment, yes or no? So that nonsense about carrying a balance to build your credit is useless. So if you don't use the credit card for years and years and years, eventually the credit card company is going to close it. And then that is problematic to the credit temporarily. So a real simple way to have a 0% utilization rate and to build your credit and to keep it really simple and to not have a huge balance is to put one recurring payment on the credit card, like an insurance bill, a bill that you would pay anyways, put it on the credit card early in the statement period, let it auto draft on the card, wait a few days from it goes pending till it finally hits the card. Then you can automate your bank to pay off that charge and then carry on with life. And just rinse and repeat over and over and over again, and you're going to see your credit just cruise on up. That's the simplest, easiest way to do this, if you're starting from 0. All right, any other questions about that before we dive back into credit stuff? Okay. All right, if you have some negative things going on, there's a little chart here that just kind of walks through the impact. So you have the action on the left, green is good, red's not good. You have the lender's interpretation of that action, and then you have the score impact. And why we don't put actual numbers on here is because it depends on where you start, where your credit starts, and other factors about how much it affects you. But take a look at this if you're curious of what kinds of things impact which way. So the big idea is take care of the responsibilities the best you can, and your credit essentially is going to take care of itself. So why does it really matter? Why are we spending this much time on this? Because if you don't have credit, which is fine, it's hard to borrow when you need to. Now, yes, in an ideal world, it's just cash is king. Just go forward, or just shave off a little bit of that gold bar you've got and call it good. It's a potential red flag for employers. Not always, but potentially. Bad credit, life's expensive. And it's expensive to borrow, which means that payment's higher, which means you've got less to work with. Your options are limited. Good credit, yeah, you've got options, and the rates are relatively low for you. Here's a little simple example of what's the difference between a score in the low mid 600s versus a score in the high 7s, low 8s. That's about a 2.5%. Well, not quite, my math's off. 1.5-ish% difference in rates. But it's about $110,000 difference over the life of the loan in this example. So just a 100 some odd point difference in your credit score means $100,000 over a lifetime of a loan in this case. That's a lot of money to give up for having a little bit lower credit score. So that's the implication here. All right, a couple ways to check what's going on. Of course, if you do a credit check, what's known as a hard pull, your credit's going to drop a little bit. This always happens whether you're going for a car loan or going to buy a house, except if you're in the house buying process, you typically have about 60 days where you might do multiple credit checks. So you're going to different banks or credit unions to get different options. A couple of different ways to check. One is go to annualcreditreport.com or go straight to Experian, Equifax, or TransUnion. Prior to COVID, you were allowed one check of these per year for free. Now, up and through December of this year, so through December this year, you can check it every week if you wanted to. You probably don't need to, but you could. What I used to do, of course, again, make sure that one of the ways to check on this is to make sure that behind the scenes credit, nothing funny is going on. Prior to COVID, I would do a quarter or a semi-quarterly kind of approach where I would check one in January, I check another one in May, I check another one in September, and then repeat the following year. Just to kind of keep tabs. It takes a few minutes to see what's going on behind the scenes, making sure there's nothing funny going on. So why do we check this? Well, because this stuff happens and life happens, like identity theft, this is just constantly ramping up and getting creative. So we need to be diligent and just tracking and making sure things aren't looking weird behind the scenes. Gives you a chance to look for inconsistencies and a chance to report or fix incorrect items. So if you find something on your credit, you go and check it, let's say later this week. You're like, what is that? Why is there a charge from New Hampshire? I've never even lived in New Hampshire, never even been there, don't even want to go there. Why is that happening? Well, then you can start reaching out and figure out what happened and begin the process to fix it. Credit Karma is a really good tool to help with this, to kind of keep tabs on things. It's free. You will be tried to be sold stuff though, just keep that in mind. But it's a free service that kind of helps keep tabs as well. Here's a little side note to pay attention to for those of you who are considering gonna borrow for something soon. So if you're like, hey, we want to go buy a house in the next 6 to 9 months or somewhere around there, or a car, something like that, now is the time you want to give yourself at least, at least 6 months, preferably 9, before you try and go down the borrowing road. So it gives you time to fix or correct or change your credit score before you get to the point where you need to tap the credit to borrow something. Because it takes a while. It's really easy to wreck, but it takes a long time to rebuild. Briefly, talk about identity theft stuff. Identity theft insurance is kind of a funny name because it doesn't protect you. It helps clean up. So it should be named identity theft service, not insurance, but that's the technical name is called an insurance. But it's really about if something happens with your identity in the medical space or with your identity financially or otherwise, Social Security, taxes, what have you, that if you pay for this service, then the company that you pay will help do the legwork to fix it. The cost here is usually $10 to $12 per person or $20 per family per month is usually what the cost is for these. I'd read a article once about, actually, I'll talk about freezing credit in just a minute, that the average identity theft issue took 600 hours to fix. That's a lot of time. So if you're like, I'll risk it, that's fine. If you're like, nope, that time is money to me, then it might be worth looking into. Credit freeze. All right, this is probably the quickest, easiest way to have some kind of protection in the financial space. It doesn't protect against medical debt. It doesn't protect against any kind of identity theft issues, but in the financial world, a credit freeze protects you from any accounts being opened up in your name, or more specifically in your Social Security number. So not even you can open up a new account if you've got a credit freeze on. So some pros: it protects against identity theft or unwanted activity in the financial space. Downside: if you need to open a financial account, you have to remember to unfreeze and then freeze each time. So it's a little bit of a manual process. You can open it up for a particular period of time. So if you're going to go buy a house or get a car, you can unfreeze it for a little bit. However, to unfreeze it, you have to, they give you a PIN. And just make sure you don't lose that PIN. You're going to have a really, really bad day. So if you do freeze your credit, protect that thing and don't lose it. Yeah. All right, how to build.
Hey, Dino.
Things. Yes.
There was a question, if you recommend freezing people's kids' credit, like minors.
Yes, it's probably a good idea to do that. I have not personally done that. Not because I don't think it's a good idea, I just haven't done it yet. So good question. Yeah, it's probably a good idea. To building the credit, one of the ways, of course, is to pay down the debt as fast as you can, be consistent on the payments. That's the quickest way. If you're kind of like, that's not the issue, I don't have credit cards, and I feel like I'd need to, you can build your credit differently than what I'm gonna walk through. And that is called Experian Go. So Experian, one of the 3 credit bureaus, just launched this early this year. And it's a way for you to, funny enough, it's basically going back to the old days when your payment history to your utilities counted for your credit. Your rent counted for your credit. So they're basically, you can begin to create your own credit by pulling in all of your monthly responsibilities, financially speaking, and they'll help build a profile, and that profile will then help build your credit. That's a new thing that's just launched earlier this year. You can also, if you want to go down on the credit card route, pick a card. Again, no fees, get rewards. One of my credit cards is a 2% cashback card on everything. And over the last 4.5 years, we have siphoned off the cash back into a particular savings account, which I will talk about on Tuesday. But we've tried to capitalize on that benefit. But if you carry a balance with a rewards card, you lose the benefits relative to what you're paying in interest. So it's not worth it. If you're going to carry a balance, the rewards are useless. Know the fee structure, know what you're getting into. Again, ideally in time, you are paying off the card multiple times, so you don't even get a credit card statement. You're so ahead of the system doesn't even know what to do with you, and they don't even send you stuff. Pay the balance off every month. Of course, paying more often helps the score. And here's a little trick. This gets in the gray waters, but it's an option. You can add a second person who needs to build credit as an authorized user. Usually this is a spouse that has poor credit and you're trying to like help raise that together. You can also give your kids a credit score by basically adding them to all of your accounts that are connected to credit. So in theory, I could give my 8-year-old, 5-year-old, and 3-year-old an 8, 10, 8, 15 credit score. I won't yet, but I could. So you could make them an authorized user on a credit card, but you don't have to give them a card. Secured credit card. That's for those who have a harder time getting the typical credit cards. Banks usually offer these, and essentially as you go into the bank, you give the bank $300 and they give you a credit card, a secured card with $300 limit on it. Now the same rules apply, the same ratio to use apply, the timing factors still apply, but that means you'll always be able to pay that card off at any time and walk away. And then usually if you use that well, pay it appropriately, pay on time, all that stuff, it'll within usually 9 months, it'll turn over to a normal, quote unquote, normal credit card. They'll give you your money back and you can keep using it. You can ask your landlord and some utility companies to report your payments to the credit bureaus. Now, if you rent from like your uncle, that's probably not going to work. But if you're at a apartment complex, or if you're renting a house and you're going through a property management company, then they more than likely can do it for you. But they're not going to do it unless you ask, and more than likely not until you pester them. But that is a way that is possible to do it. Just a quick couple questions in the application space. One step would be to check your credit reports if you haven't for a while. Thinking about how does credit financing life fit into the family vision? And then specifically, what actions can you take to increase credit score? And then of course, the family vision, how does it color or influence how you approach credit, big picture? Pause here. Any questions about credit before we tackle the massive world of insurance in 30 minutes?
There was a question, Dino, does freezing your credit affect your credit score?
No. Because you can still use whatever accounts you have open, you still use those. Well, when I say normally, what I mean is that like appropriately, and it will not affect your credit score. Good question. All right, I have a warm-up poll for us. This might feel kind of left field, but I am going to go somewhere with it. So bear with me. This is a multiple choice, has to do with fear, particularly financial fears. It's a long list, so take a moment, read through it, and then when you feel like, yeah, this seems like this could be a fear of mine. So the question is, what fears do you have around money? So take a few moments, and again, multiple choice and anonymous, go for it. So for those of you having a hard time reading it, it's not having enough of retirement, unknown, unseen future, or unsure future, my own choices, never attaining dreams, not being on the same page as partner, failing health, my kids not making wise choices, not knowing what to do. Other, I will ask you what it is. And just for kicks, I eat fear for breakfast. Okay, we're about halfway there. Thanks for that. Keep going. A couple more people. I'll wait a little bit longer for this one. Excellent. All right, I'm gonna go ahead and end it and share this with you so we can all take a quick peek at it. So maybe if fear is a little too strong of a word, then maybe concerns could still work here. But a lot said not having a retirement, unknown, unsure future, a couple of my own choices, retaining dreams, not being on the same page apart, failing health. My kids not making wise choices, not knowing what to do. A few of you said I don't fear. What is that? Does that go on my lucky charms? So why are you asking Dino about financial fears in between credit and insurance? So the reason for this is when we think about insurance, it's about mitigating risk. And there's a lot of fear and risk blend in finance and in just in life. And of course, we can never reduce risk to the point of zero where it has no impact. Because if you stay inside because you don't want to face outside, there's all kinds of risks. The second you leave your front door, you're facing a new set of risks. But insurance is about mitigating some or maybe some major components. And fear is a funny filter for financial choices and decision making, which is why we encourage families to supplement fear with the family vision and let the family vision drive our choices and decisions and not fear. Though there may be legitimate concerns about areas where we don't have control, or we see the trajectory of our kids and we're staying up late at night and all kinds of concerns, or what are the people in the office going to do in Washington, like on and on and on and on and on. And so when it comes to, when talking about insurance, we need to focus on the areas that you have the agency, that you have the control, that you have the influence on, and then make decisions from that, because you and I can't speak into what's happening in small little dark rooms in Washington that have a trickle effect on you and I. Nor are we sovereign enough to control everything about our lives. So hopefully, as we think about insurance, remember stewardship, it's a relationship to money, and the big one, how does this fit into our family vision? How do we use insurance from a defensive point of view, because that's really where insurance sits, the defensive strategy, financially speaking, to help us live out what we want to work towards today and prepare ourselves to do that tomorrow. So I'm going to briefly walk through this. All kinds of risks: getting sick, death, pet emergency, break a bone, canceling expensive wedding, getting robbed, stolen identity, losing fantasy football, breaking your phone, and a slew of other things. And these are all real, of course. You can get insurances for all these. I used to have on here chicken, like chickens. as in like you can get chicken insurance, it's a thing. In one respect, again, if you work in insurance, just turn off the part of your brain that'll get offended about things I might be saying throughout this time. I'm not picking on you, so I'm glad you're working. And it's a needed field. But if there's a way for an insurance to make money, they're going to figure out a way to do it. They'll figure out a way to insure something. If you really like your pinky, you can get it insured. So all this. All right, so back to the real point here. Again, insurance reduces the financial impact of a risk. We know life happens. If the risk is unlikely, the insurance typically will be cheaper. If the risk is unlikely and would have a severe impact, that's typically where insurance sits. That's kind of where the space that we're going to be focusing on. So assess risks for your family and the likelihood of something happening and the impact of that thing happening. We're just going to be talking about a couple of major areas. I'm not going to go down every rabbit hole here. And then figure out which risks can we afford to take and which we can't. Or what are we not willing to take in terms of risk? Assess with a vision and impart the emergency fund. So from our first list here, I'm just going to walk through a couple of these. So the risk of canceling a wedding, that should be pretty low. Maybe deferring it is different than canceling, but that should be pretty low. The severity, well, it depends how much money you put into it beforehand, also pretty low. So should you get insurance for that? It's called cold feet insurance. That's the name of it, if you're curious. I won't walk through all these because they're in your book. All right, so what should we get? Now, as we walk through these three main pieces, do not feel overwhelmed by the end of our time. Be like, man, I have to get every insurance under the sun. How am I going to do this? Think of it in stages and think of it in terms of what's most important right now. And most of you already have some of these anyways, but we're still going to run it through the stewardship and family vision piece. So again, first thing up is we think about insurance in light of the family vision, the priorities, the values. Where are we headed? Why are we heading there? Now, let's think about insurance. Context, what's happening in your world? What's the likelihood and severity of something happening? If you travel 150 miles a day in your car, because that's what you do for work, you should probably have some epic car insurance. You should not have the cheapest car insurance on the planet. If you sit at home all day for whatever reason, and you drive maybe 1,000 miles a year, you probably don't need a lot of car insurance. Affordability. Will the risk cause cash flow issues or cause debt or cause bankruptcy? The question to consider is maybe not so much can I afford it, but can I afford not to have the insurance? So again, family vision, context, and affordability. All right, real simple insurance. Most of you probably know how this works. You have an issue and you have your part, which is deductible, and then you pay that, and then the insurance, in theory, covers the rest. I'm sure there's all kinds of stories where this process didn't quite work as simple as it outlined. But the point to pay attention here is that deductible amount. So if you do not have insurances, pick a kind, then your emergency fund has to be bigger to offset the lack of insurance. So the less coverage you have, the less assistance you have in the insurance space, the more reserves you have to offset potential losses. The more insurances you have and the appropriate coverages you have, you can have a smaller emergency fund because you have more help. Now, this is the challenge, though, between these. So if you have an accident, no emergency fund, or you have to use the emergency fund more likely and maybe add debt, So you have the potential of going totally down to zero and then having to borrow. If you got insurance with a high deductible, which means you got to have a lot of money up front, but then insurance covers everything else. You want to make sure you've got enough in the emergency fund to cover that. So if you have high deductibles, and we're going to get more into savings again on Tuesday, but this is something to pay attention to. We typically talk about having 1 month's worth of savings as a starting emergency fund. And a part of that should be money to cover deductibles, whether for homeowners or renters or car insurance or medical insurance. Those typically are the three that you would need deductibles for. It's a good starting place to know how much should be in my emergency fund. Well, enough to cover your deductibles plus money to cover bills. And then insurance with a high monthly premium. The emergency fund can be a little bit smaller, but here's the tension. If the deductible is super big, that means your payment's going to be small. So you have more room in the budget, but you have to repurpose a lot more money to build the emergency fund. But if you have a really, really small deductible, you don't need that much in the emergency fund, but your payment's going to be bigger. Right? Well, that puts pressure on the budget. So there's this tension that you cannot get away from if you get insurance, where you have to play with those numbers. And by the way, once you land somewhere, you can change that over time. So if you said, let's just go for the low deductible and higher payment, so we buy some time to slowly build the emergency fund, and then once you get that emergency fund where you like it and you've got the deductibles, then switch it. Drop that payment, raise the deductible, free up more money in the budget. You're not locked in. You can change that typically at least once a year. So some application questions to consider early on. What can we afford each month, premium-wise? And what can the emergency fund afford? We're going to talk about pulling all these premiums and monthly payments together next Thursday night and the budget piece. But for now, just be thinking about, what do we need? What's appropriate? And what can we afford in light of the family vision? Now I'm going to make a closer connection to insurances and family vision when we get into life insurance. Car insurance, start here real quick. These are the kind of 4 or 5 main categories: liability, comp and collision. Liability is your basic medical coverage, and then it gets more comprehensive as you go through this. Comp and collision is kind of the most robust, and you add uninsured motorists and medical payment, extra medical payments, and then you can get into smaller things like rental and towing. Again, you have all this in your book, so I'm not going to walk through each one, but here is a question I want you to focus on the most. There's some questions to think through. However, the one I want you to pay attention to the most here, highlight this. Here, I'll do it. This one right here. No, I love my circle. What's the car's worth to your family? It might be worth $400, but to you, you need that thing to last 5 more years. So that's an important question relative to how you want to have your insurance. And increasing insurance is relatively inexpensive to jump protection. It usually, to increase coverage from 100,000 to 200,000 or 300,000 is typically $10 to $15 more a month. So again, think of your coverage relative to the cost in context to your family vision. I'm not going to spend a lot of time here because this world is so nuanced, but I will talk about a couple of things. Knowing, yes, there's tons of options. It sounds funny. Maybe the best plan for your family might be different plans. So maybe the primary earner is on the employer plan, and maybe the kids are on OHP and WHP, and then maybe the stay-at-home parent is getting a marketplace plan. In terms of doctors and hospital or doctor visits, and that's super annoying, and you're going to be all over the place because you got 4 different docs. I get that, but it might be that has to be the case for some time to make that coverage work. Got options, your employer's plan, Oregon, Washington health plan. So you have the websites there in front of you, healthcare.gov or healthcare.oregon.gov, Washington Health Plan Finder, the Federal Exchange, just the overarching umbrella, healthcare.gov. MetaShare, it's like a community subscription model where you pool your money together with people from all over the country, and then whoever has needs pulls from that pool. There are mixed reviews on that. We have some families at Birch that got burned by it. Other families at Birch that they've gone through cancer and it's been amazing. That's about all I got for you there. And then going direct, Providence, Legacy, Kaiser, Costco even. Oh, one last thing here. Dental, which if you can even call dental insurance, that's arguable. But Costco used to have a direct dental plan. They don't anymore. For some reason, they've canceled that temporarily, they say. But another option is something like Willamette Dental or the small little clinics that you can get your own subscription to if you're looking for that. Or if you're like, yeah, I don't know if I want to pay that, then dental schools have reduced cost. So you have dentists in training, supervised by licensed professionals working on your teeth. Feel free to roll the dice on that one. I do know people that use it and it's worked well. But if you're looking for some simple work for really inexpensive, that would definitely be a way to go. All right, renters, home insurance. This just protects your stuff. That's actually important, particularly for the renter. Because if you rent a home, let's say, the homeowner, their insurance cannot protect your stuff because it's not their stuff. So you can only protect that which is yours, that which you own. I was in a house fire in 2000, and we were renting someone's home. The fire was in the house. That's another story. If you want to hear it, I'll tell it sometime. And we did not have renter's insurance. And I was in a weird place because I was subletting from the renters. Well, I didn't have subletters renters insurance. They didn't have renters insurance. And the homeowner was like, we're sorry, but we only protected our house. We can't protect your stuff because we don't own it. So that's why I'm defining that. It's really, really important. Renter's insurance is usually inexpensive, $10 to $15 a month, thereabouts. Most places now require it. And usually the coverage is up to like $25,000 worth of stuff. And when you think about your own things, in insurance world, there's a difference between the actual cost and the replacement cost. So when you think about your insurance, and I'm going to have you do an audit on this. Well, you'll do it, but hopefully soon. You just look through your stuff and be like, well, my couch is only worth $100, but to replace that, how much is that going to cost? So think in terms of insurance. So that's how you build out how much coverage you're going to have. For those of you who are homeowners, this does not come standard. Hear me now. You have to look for an inflation clause or inflation protection rider. So currently what's happening is that you have this epic home value inflation and cost of goods epic inflation. But is your insurance keeping pace? It doesn't happen automatically. It has to be built into the contract. Is total, Megan, your question is total replacement cost insurance the same as inflation clause? Only the way that that's the same is on if you have to rebuild part of the house, not necessarily your stuff. Hopefully that answers your question. The inflation clause is it's fairly minimal. My insurance is with USAA, and I was not a veteran. I married into a veteran family. That's how I got it. And it comes with the homeowner's insurance. It's automatically built in. Now, is it priced that way? Probably. But not every insurance does that. So it's a good asterisk right here for those of you who are homeowners. And then lastly here, document the belongings. So the easiest way to do this is to take a video of your stuff and walk around your home, apartment, wherever. Say, yeah, I bought this. This is mine. I've had this for this long. That's simple. Save it to the cloud and you're good. Otherwise, and this sounds funny, if something happens and you go to insurance and you submit a claim for $8,000 worth of stuff, and they're like, where's the receipts? Like, well, I've had this stuff for like 10 years. I don't have receipts for 10 years. How do we know it's yours? That's harsh, but protect yourself in this way. All right, I'm gonna spend a few minutes here. Life insurance. Yes.
Will the inflation clause cause your premium to go up?
It probably will, yeah. But it shouldn't go up a lot. It's the natural trajectory for most places, but it is definitely worth checking to make sure that you have that in place. All right, life insurance. Big idea here is to provide for the survivors in the home to maintain some sense of normalcy, at least for a little bit of time. There are two main types. There's term, which is a form of renting. So you rent a policy or you own a policy for a particular period of time, usually in 5-year increments, 5, 10, 15, 20, 25, 30. And then after that, the term is over, you're no longer covered, and you can either get a new term, renew it before it ends, or carry on without it. Whole life is exactly what it sounds like. As long as you can make the payments, you can have it your whole life. Typically, the rates change throughout your life. So the older you get, the more expensive this becomes, unless you get a fixed whole life policy, in which case your payments start out kind of high and then just park it that way the whole time. So term is typically almost exclusively less expensive than whole life, but you don't get it your whole life. You only get it for a particular period of time. So a couple of things around like, well, okay, so there's the two options, but then how much? So here's some things to consider. Somewhere in the neighborhood of 10 to 12 times your annual income in coverage amount. Maybe enough to pay off the house if you own a home. Maybe enough to provide income for a certain amount of period of years, or maybe pay for kids' college, or to do all of it. The life insurance is paid out for all types of death, with the exception of suicide. And in life insurance, you cannot claim life insurance if it's been under 2 years. If someone commits suicide and owns the policy, if it's been under 2 years, they will not pay out. If it's over 2 years, then they will. If you accidentally die, it pays out. So there's another thing out here called like accidental life insurance. It's like a kicker. You don't really need that because this is what it's for. It's accidental. You don't get life insurance because you're presuming to go. It's typically because you don't know you're going to go. Yes, certain pre-existing conditions will exclude you from getting life insurance. Some pre-conditions, you can get it, but it'll be more expensive. So yes, health does play into it, which is why it's recommended to get it earlier rather than later. So I told you earlier, I'm going to connect family vision and insurance. So walk you through briefly what my wife and I have chosen to do in this space. So for me, we chose to do a 20-year term 8 years ago now for $500,000. That cost me $54.15 a month, has for 8 years. At the time I had higher cholesterol. I don't anymore, but then I did. So it was a little bit higher. And that $500,000 would be enough to pay the house off. And then the rest, because it's tax-free money, the rest would be invested. And then my wife, who stays home with our 3 littles, would get supplemental money from the investment along with Social Security survivor benefits. And that would allow her to stay home and raise our 3 kids without having to do something drastic. So that $54.15 for the next 12 years, assuming I don't have to use it, buys us 12 years of some sense of financial security as it relates to this issue. Because part of our family vision is for my wife to stay home by choice, to be able to spend a significant amount of time discipling our little people and loving on them well. Thankfully, Lord willing, we're in a place to do that. Now, what happens if the stay-at-home spouse is not covered with life insurance? Uh-oh, now there's a problem. So, interesting enough, stay-at-home parents, particularly stay-at-home mom, is the least insured category in the US. Above them are kids. And then the breadwinners, the first one. So because of that, we chose to do a 15-year term for my wife for $250,000 at $13.32 a month 8 years ago. And that would be enough to pay the house off. And then the amount that's left over would either be used for college for the kids in the future, or like help for me to figure out what do I do with an 8, 5, and 3-year-old when I'm still needing to work for lots of different reasons. So it gives us flexibility, though, of course, the family dynamic and the family vision drastically shifts because now one of us is gone, but it allows some sense of normalcy to maintain while a lot of life happens. Because besides taking the emotional and the relational hit in the weeks, months, years, decades, generations to come, you don't want to add financial chaos to that. So I've been at Birch now for 7.5 years, and I have met with thousands of families. And every year I have met with a recent widow. So there have been 6 now widows at Birch who current participants, I think there's 2 there who are still here, whose husbands passed away. And they all had kids. Only one of them had life insurance. And the conversations that I've had with the other 5 women were a lot harder because there wasn't any resources to help make the transition and shift. I don't say that to scare you. I just like, these are the real conversations I've had and the challenging ways to get creative financially to help make it work for just a little bit amount of money to be able to cover that. None of those six families ever imagined they would have to be walking this. No one does. And it's fair. But in case it does, I would encourage you to just have a serious conversation. So Megan, your question, what happens if the term is up? Then I'm not covered anymore. So prior to leading up to my 20-year term, we will look at our family context, we'll look at the vision, we'll look at what's happening, what's working, what isn't working, and say, yeah, let's go ahead and get another 10-year, or let's convert this to a whole life because one of our kids just got disabled and he's going to be with us forever. So we adjust and change depending on what's going on. Or if we get there and realize, no, we're fiscally, we're fine, my wife's working, the kids are gone for whatever, like, and we don't need it, then we don't get it. But you want to know that before the term ends. You want to know what you're going to do before it ends. Good question, Tess. Small print. It depends on the kind of insurance you get. With term, there's not a lot of fine print. With whole life, there is a whole lot of fine print, depending on the kind. There's about 8 different versions of whole life, which I won't get into. Part of it is the timing of the payout. Part of it is when it can be converted, if it's a term policy, when it could be converted to a whole life. But it really depends on the kind that you get. Most of the small print stuff is upfront, like the medical background checks and such. All right, and a few more minutes and then we'll be done. Piggybacking off of the life insurance is briefly about estate planning. Hopefully, many of you got a chance to come to the estate planning and wills class that was taught a couple weeks ago by Steve Bennett. It was a fascinating conversation. I was super grateful for him. We will be doing it again in the future, but for the short version in the next like 12 seconds, I'll talk through this. So some big ideas to think about here. First, legal documents, trust. That's a big, robust, probably the best thing to do in the estate planning world. Keep stuff out of probate. It gets real granular in terms of controls that you can put in place. You put your assets into this. Basically, you create a corporation. It typically costs about $4,000 to $5,000 to set up. It is an expensive upfront, but it's super robust. Next up would be a will. That is a lot less expensive, just as important and meaningful, though it takes longer to work out, and it goes through probate, which is the court process. Power of attorney, that gives somebody in your life the power to act on your behalf, financially speaking, in case you become incapacitated. In other words, you're not able to do it for yourself. Healthcare directives. Hey, do I go on life support? Do I not? If I do go on life support, how long do I do for? Those kinds of things. They're tricky conversations to have over steak and potatoes. So you might want to wait to do that later in the evening after the kids are in bed to have that conversation. Different letters of instruction. Those of you who know Tina Birch, the other financial counselor, she is my sister-in-law. And if something happens to my wife and I at the same time, she gets our kids. Yay. But that letter of instruction, we wrote to her a lot about my family because she doesn't know them well. We wrote a lot about our church and our the family culture that we're building here in our home. So it gives her some guidance on what do I do with her, Dino and Deborah's kids. So it's not legally binding, but it gives her some direction on what to do. And then some idea, what's called a legacy box. It's not my term. I borrowed that from Dave Ramsey. It's basically where you have a package deal where you put your insurance policies and master password list and contact info and licenses and like your big important box. I'm going to go a few minutes over. I won't be very long, I promise. So hang in there with me. So great question. Do you recommend seeking legal help from attorney to set these things like a will or so on, or do it yourself? I would typically recommend going with somebody. So like I said, a trust would be about 3,000, 4,000, 5,000, depending on how complicated the situation is. Hiring an attorney to do your will be anywhere from 400 to 600. And then you can do things like freewill.com, which is a legitimate website, or where I recommend as well is Nolo's Quicken Wills and Trusts. You might recognize that middle word Quicken there. They show up, Nolo's Quicken Wills and Trusts shows up on like the top 5 online will making websites everywhere. And I'll stick around a little bit too if you have any more questions. Yes, once you do fill out any online documents, they need to be printed, signed, and notarized. The signing and notary happens at the same time. So just because you write them does not make them legitimate. They have to be signed and notarized. Thanks for that, Tess. Last couple of bits here, disability insurance. This just helps with the income if something happens, particularly happens with your ability to work in your fields based on several different things: your industry, age, health, length of time the insurance will last, the length of time it takes for the insurance to kick in. That's the deductible, if you will. But the interesting thing about disability insurance is that it's statistically 5 times more likely to be needed than life insurance. It's a fascinating statistic, which in my world, I actually got life insurance first, and I was teaching on this for years before I actually got disability. So I used to teach this 7 to 8 times a year, restart. And every time I would teach this section, I'd talk to my wife, should we talk about disability yet? For years. And then we finally did a couple years ago. Long-term care, this just really is about offsetting costs later in life, helping in nursing homes and home care. For those of you in your 30s, wouldn't worry about this. It's generally purchased for those who are in and around their 60s. So if you are working with your parents, this is a good conversation to have. It's expensive though. And what I mean by that, it's upwards of $300 or $400 a month. But what it also does, it helps preserve any assets for a lot longer. You can also add long-term care insurance as a rider. A rider is just an additional policy on a current whole life insurance policy. And it's a lot less expensive to do it that way. And lastly, umbrella insurance, it's exactly as it sounds. So it's a insurance that covers any gaps in any other your major insurances, particularly homeowners, medical, and automobile. So for example, if you're in a really nasty car accident, multiple parties involved, and your insurance caps out like 100,000, and there's still bills to be paid, umbrella insurance just start cutting checks. But to qualify for it, you have to have at least a certain amount of coverages on those other areas. And umbrella policies, like renter's insurance, is cheap, $10 to $15, and get this, per million. So umbrella coverage starts at $1 million. That's the low end. But you really don't need to tap into this until you start getting significant assets. And by significant, I mean somewhere around the $500,000 mark. Or if you've got some other mitigating factors that you would feel like, I just feel like I could use this. Essentially, if you're like, well, how could I afford an extra $15 a month? And you look over your budget and you're like, wait a minute, Hulu, Netflix, Disney Plus. All right, figure that one out. Okay. Application questions here again, family vision, family vision, family vision. All right, that is probably plenty for tonight. So over the weekend and into early next week, spend some time working through this: stewardship, relationship to money, family vision, thinking about institution, credit, insurance, and how does it all come together into family vision. Tuesday night, we will get after debt and savings. It's not Monday night. We do have one more week, Tuesday. Debt and savings. Thanks, everyone. And I'll stick around for more questions. Have a great night. Have a blessed weekend. Enjoy the summer goodness and hope you can stay cool somewhere.